Hi, everyone. My name is Bonnie Luttrell, and I work for the Student Borrower Protection Center. Before we dive in, I want to mention that if for any reason you need to log off early, please know that the recorded presentation will be made available on protectborrowers.org/webinar, and as well as forgivemystudentdebt.org. In today's presentation, we will focus on immediate steps you can take to manage your student loans if your job, finances, and family are impacted by the coronavirus pandemic. This information is based on programs and protections that are available to you now. However, we know that things are changing every day, so should Congress officially pass any program to provide extra relief to student loan borrowers, please know that we will inform everyone who registered to attend this webinar. In the meantime, please be cognizant of scams that market themselves as student loan forgiveness or debt relief. Remember that you should never, ever pay anyone to help you with your student loans. In today's presentation, we will discuss options for repaying federal student loans with a focus on income-driven repayment. We will also talk about how to get out of default to protect yourself against wage garnishment and tax refund offsets, and also options for dealing with private student loans if you are in financial distress. So with that, let's dive in. Broadly speaking, there are two types of student loans, federal and private. Federal student loans are made by the Department of Education and have names like Direct Loans, Parent Plus, Stafford, etc. Private student loans are made by private companies like Discover, Wells Fargo, or PNC Bank. If you're not sure what type of loan you have, our FAQ document that we circulate around at the end of the presentation will talk about how you can find out. Most borrowers have federal student loans, so that's where we will start today. Federal student loans offer a variety of repayment options, but very broadly speaking, there are four types of plans: standard, extended, graduated, and income-driven. The first repayment plan is called standard. This is the repayment plan that you start in as soon as you leave school and exit your grace period. For most borrowers, a standard repayment plan requires that you pay the same amount every month for 10 years, at which point your loans are paid off. If you have a consolidation loan with a high balance, this period may be extended out over 15, 20, or even 25 years. If your payment under the standard plan is unaffordable, you can choose from any of these other options. Extended repayment, on the top right, offers you a payment lower than your standard plan, but over a longer period of time. You will end up paying more interest on your loans in the long term, but it provides immediate relief from your monthly payment burden. Graduated repayment works kind of like a staircase, as you'll see on the lower left. You start paying small amounts, and then every 2 years, your payment amount increases. During the second half of your repayment term, your payments will generally be higher than they would have been under a standard plan. And finally, in the bottom right, you'll see the plan we're going to focus on today: income-driven repayment. Income-driven repayment plans, also called IDR plans, are unlike any other repayment plan in that they peg your monthly payment to your income, not your loan balance. As a result, you should never have to pay more than 10 to 15% of your discretionary income. And if you stay enrolled in an IDR plan for 20 or 25 years, depending on the specific IDR plan you're in, you can have the remaining balance of your federal student loans forgiven. There are 4 types of IDR plans available based on what type of loan you have and when you took it out. These plans are called income contingent repayment, or ICR, income-based repayment, or IBR, pay-as-you-earn, or payee, or revised pay-as-you-earn, or repay. Don't worry if this seems like a lot of information. You as the borrower don't actually have to know the difference between any of these plans. I'll explain more on that in a minute. One of the best features about income-driven repayment plans are that if you are unemployed or have low income, your payments can actually be $0 per month. I know there is a lot of technical information on this slide, but the one takeaway is that if you are struggling, this is the best option to get your payments immediately recalculated to an affordable amount. Additionally, if you are enrolled in a standard plan and you or your partner are currently employed but at risk of being laid off, IDR may be a good option to free up some cash in the short term. If you want to estimate what your monthly payment would be under one of the IDR plans, you can use the formula posted here. In short, your payment is 10 to 15% of your discretionary income, which is calculated based on a portion of your adjusted gross income, or AGI. If you don't want to do the math yourself, you can use the Department of Education's repayment estimator, which lets you plug in numbers to do the math for you across all of the repayment plans. This link will be included in the FAQ document that we will send around after the presentation. Here are some of the other great things about IDR. Many of the plans offer certain interest rate subsidies on your loans, meaning the Department of Education will pick up the difference on any interest not covered by your payment. Additionally, if you are currently delinquent on your student loan, enrolling in an IDR plan will automatically bring you current without you having to go back and make up your missed payments. Finally, one of the most significant benefits of IDR, and what we'll focus on next, is that if you experience a change in income, like you or your partner losing a job, you can have your payment immediately recalculated to factor in this change. Next, we'll take a look at how to enroll in one of these plans. There are two options for enrolling in an IDR plan. You can submit an electronic application online, or you can submit a paper application to your servicer directly. Regardless of your situation, you can start the application online. However, if your last tax filing is not reflective of your current income, for example, if you were recently laid off, then you will be instructed to finish the application outside of the online tool. We'll talk about that more in a second. I mentioned previously that you didn't need to know all of the nuances between the different types of IDR plans. That's because the IDR application includes an option to have your student loan servicer place you in whatever plan offers you the lowest monthly payment. For most borrowers, that will be pay-as-you-earn or revised pay-as-you-earn. For Parent Plus borrowers, the only IDR plan you're eligible for is income contingent repayment. To enroll in IDR online, the first step is to go to studentaid.gov and log into the Federal Student Aid interface. Navigate over to Manage Loans and apply for Income-Driven Repayment Plan, and it will guide you through the rest of the way. Keep in mind that there will be different options for enrolling in IDR for the first time and recertifying income for an existing plan. At that point, you can navigate to the enrollment wizard until you get to the questions about income. If you want to use last year's tax information to enroll, you can actually connect to the IRS website and import your income information all directly within the tool. I want to highlight a couple pieces of information for married borrowers. Under all of the IDR plans, if you file taxes jointly, your spouse's income will be considered when calculating your payment. There are also options if you are separated or otherwise don't have access to your spouse's income. If you file separately, your spouse's income will only be considered under the revised pay-as-you-earn plan. And if your spouse has federal student loan debt as well, that debt will be taken into consideration when calculating the monthly payment. So finally, after you complete the information and hit submit, the information gets automatically routed to your servicer, and within a few weeks, you should be notified of your new IDR payment amount. If, for any reason, your last tax return was not representative of your current income, job loss, cut hours, anything at all, I recommend starting with the paper application. Most servicers let you scan and upload the application on their websites, along with proof of income. You can also mail it in. The first step is to complete the application and attach proof of current income. Proof of income should be no more than 90 days old. You can attach a recent pay stub or a letter from your employer stating how much you work, how much you earn, and how often. For example, if you are using a pay stub, write on it paid every week or paid every other week. If you were recently laid off, had your hours cut, or have no income, you can also do what's called self-attestation of no income. To do that, all you need to do is check the box that says you have no taxable income. No additional documentation is needed. Now I want to take a minute to address some suggestions in case you are facing a sudden income shock. First, if you are enrolled in auto pay, Keep in mind that it takes at least 3 days to suspend the payment. So if your payment is due at the end of the month and you think you're going to get laid off, consider stopping autopay now. Note that this will stop the 0.25% interest rate reduction offered to all borrowers in autopay, but it will also keep your account from becoming overdrawn while you're managing IDR enrollment. Now, also keep in mind that right now, the federal government has authorized an interest deferment and 60 days of forbearance for all federal student loan borrowers. Which brings us to the second point. If for any reason you can't get the payment situation on your federal student loans sorted before your next payment is due, remember that there is no derogatory credit reporting on a federal student loan for at least 90 days. That means you won't be immediately reported as delinquent. And if you need some time to get everything in order to get your IDR application filed, most servicers allow borrowers to enroll in hardship forbearance online. Just log into your servicer's website and search for forbearance. The clip here is from FedLoan's website. Just answer a few questions about financial hardship and your request is sent for processing. Servicers have updated their websites to instruct borrowers about how to navigate this process if they're experiencing hardship in light of the ongoing coronavirus pandemic. I want to spend the next few minutes going through a few scenarios we've seen pop up in the last few days. I just lost my job and my payment is due next week. What do I do? So we've actually seen this quite a bit from substitute teachers, construction workers, and a lot of folks in the restaurant industry. The first thing I would recommend is making sure your auto pay is not going to go through. Get that stopped because you can't get that money back once it's processed. Next, go to the IDR application and self-attest to no income. What if you still have a job but you have no hours? In this situation, you can either attest to no income or include a letter from your employer signed and dated stating that you won't be receiving income. This will lock in your $0 payment under an IDR plan. What if you just renewed your IDR plan and they said you had to wait 12 months to recertify? What if your income decreases? If your income decreases, you can immediately recertify. You don't have to wait the 12 months. And to the next question, you don't even have to wait for your unemployment benefits claim to be processed to recertify. While unemployment benefits are considered when calculating your IDR payment, you can apply right away while you still have no taxable income. Now let's shift to what to do if your federal student loans are in default. Federal student loans come with a lot of scary things if they default. You can have your wages garnished without a court order, you can have your Social Security benefits offset, your tax refund can even be withheld. So if your student loans are in default and you were really depending on your tax refund to get you through the next few weeks of uncertainty, let's make sure that refund is protected. There are two main ways to get out of default on a federal student loan, besides paying off all the debt. The first option is consolidation. Simply put, consolidations bunch up all of your defaulted loans and pay them off with a new loan at the same interest rate, and you start over. To be eligible to consolidate, you have to have at least one eligible loan. We'll talk more about that in a minute. You also have to agree to enroll in IDR at the time of the consolidation application. You cannot immediately consolidate your defaulted loan if your wages are currently being garnished. The second option is rehabilitation. A rehabilitation plan lets you make 9 payments to your debt collector. After you successfully make those payments on time and in full, your loan exits default and is transferred back to normal servicing. Rehabilitation is a little bit more complicated than consolidation, and I'll explain why, but generally my recommendation to borrowers is to pursue consolidation. As long as you are not currently in wage garnishment, the consolidation process can be completed entirely online. You log on the same way you would as if you were enrolling in an IDR plan, and you can complete the whole application process in one sitting, the consolidation application and the IDR enrollment application. A couple of things to keep in mind. While consolidation does remove your loans from default, it will not change existing credit reporting. You will still have a defaulted loan on your credit history, but it will start the timer over again, so it will fall off eventually. Traditionally, the entire consolidation process from the application to getting your first bill takes about a month. However, we do not yet know if there will be a disruption in the consolidation processing due to the ongoing burden on servicers to process paperwork. I recommend getting the application in as soon as possible if this is what you want to pursue. The other option available to defaulted student loan borrowers is rehabilitation. One thing I want to flag up top, rehabilitation requires a lot of communication with your debt collector. As more and more call centers are getting shut down, it's important to know that this may be a really difficult option to pursue right now. As I previously mentioned, in a rehabilitation plan, you make payments for 9 months. Those payments can actually be adjusted depending on your income and expenses, but must be at minimum $5. If your wages are currently being garnished, the garnishment can be factored into the payment amount, and after 5 on-time payments, the garnishment will be lifted. Completing a rehabilitation plan will also remove the default from your credit history. It won't remove the month of delinquency that preceded the default, but you will no longer have a default noted on your credit file. The reason why I recommend consolidation over rehabilitation is that consolidation can be completed at once, and so there's less room for error. If you are trying to rehabilitate your loan and the collector miscalculates your payment, which actually happens quite often, then none of the payments you make will count towards the required 9. Just something to keep in mind as you explore which option makes the most sense for your situation. Here are some other things to keep in mind. If you have redefaulted, meaning you were in default once, got out, and then defaulted again, note that your options may be more limited. For example, if you already rehabilitated your federal loan but defaulted again, you cannot rehabilitate again. Second, if you have already consolidated a federal student loan, you may not be eligible to consolidate out of default. You need at least one eligible loan to consolidate. Finally, if your wages are being garnished and these options to remove the garnishment aren't available to you, you can request the garnishment be lifted for 12 months through an administrative hearing. Don't let the word hearing scare you. You can do the whole thing over the phone and computer. Just log onto the website listed there on the screen, access the hearing request form, select the reason why you are challenging the garnishment, and then say you want to conduct the hearing over the phone. One thing everyone should keep in mind, particularly given the time of year, if you are expecting a refund this year, consider requesting an extension to file your taxes. I know the filing deadline has already been pushed back a few months, but if you need more time, this will buy you some extra time as you sort out your loans so you don't lose your refund in an offset. Now I want to shift to private student loans. While private student loan borrowers don't have any of the guaranteed rights that federal student loan borrowers have during times of financial distress, there are still things you can do. Many private student lenders offer alternative repayment plans. You just have to be persistent. Again, it may be difficult to get these plans locked in because of call centers getting closed, so try to get in touch with your student loan servicer through other means. Email, online portals, social media DMs, any way that your servicer provides to get in touch. Private lenders may offer temporary deferments on payments, interest rate reductions, or other options. Some lenders, like Discover, publish these options on their website. Others are more reluctant to offer them, so again, be persistent. Ask to talk to a supervisor if you need to, and if you are denied, ask why. If you do successfully get into one of these repayment options, make sure you confirm how it will be reported on your credit. One important thing to keep in mind on private student loans is that things are changing every day. More and more lenders are committing to waiving late fees, and we also expect more lenders to offer temporary payment relief amid the chaos. So the best advice I can give here is check in early and often and be very upfront with your lender about any financial difficulties. As of right now, some private student loan debt collectors are still pursuing judgments. Here are some of the recommendations to work with your collector to ensure it doesn't escalate amid all that's going on. Negotiate with your collector, and if the first person you speak with isn't receptive, try again. Figure out what you can afford to pay, if anything, and offer that. Always get the settlement or modified payment amount in writing and confirm how it will be reported on your credit. And finally, remember that private student loans are subject to a statute of limitations. This means that after a certain amount of time, as long as you haven't reinitiated payments. The collector cannot pursue you in court for payment. Most of the options I talked about today require you to get in touch with your servicer or collector. However, that's not really helpful if all the call centers are shut down or understaffed. So here are some alternatives if you can't get through by phone. Emails and social media accounts are still being monitored, and from what we've seen, many of the servicers are actually being most responsive when borrowers call them out publicly. So if you can't get through, don't be shy about contacting these companies through Twitter, Facebook, Instagram, and of course, email. We've seen numerous examples now where this approach ensures the borrower's account gets handled by an escalated case team member. And I promise you, your student debt is not something to be shy about. 44 million people have student debt. Another borrower defaults on a federal student loan every 26 seconds. Your tweet to your servicer complaining that you can't get anyone on the phone to help is the same thing that millions of borrowers are dealing with. Finally, I want to share a couple of additional resources. First, AFT has a great website called Forgive My Student Debt. It focuses on public service loan forgiveness and teacher loan forgiveness, but it also has great resources for income-driven repayment. The National Consumer Law Center Student Loan Borrower Assistance page has great information as well. And also the Department of Education's repayment estimator is linked here, which I mentioned several times throughout the webinar. The information will all be in the follow-up FAQs that we send around. The recorded webinar will also be posted on these pages listed here.